Well, Donald Trump, just now, moments ago, just minutes before the Federal Reserve releases their statement that they won't be cutting interest rates, Donald Trump releases a statement saying, keeping interest rates high is hurting people. We should lower interest rates. This is what he's saying just right now. Reuters is reporting it. And to this, Jerome Powell says...
Just close the fucking door. Close the door.
Because he ain't gonna cut rates today. Anyway, welcome back, everyone, to another FOMC presser. Nobody's actually expecting Mr. Too Late to cut rates today. But Jerome Powell says... more updates coming through now. All because of the Fed. Keeping interest rates high is hurting people. We should lower the rates. All because of the Fed. Yeah, well, we're going to hear a lot from Jerome Powell's point of view on his bully pulpit in about 40 minutes. In about 40 minutes, we'll get Jay Powell up on stage. We'll have bingo. We are going to get a statement with no summary of economic projections this time. Unfortunately, I always like it when we get to go through the dots. We'll be able to pull up the prior dots, though, so we could go through the good old dots, the dated dots, the dots from last month. I think really what we're going to get today is a setup for how important this Friday is going to be. There's even a chance Jay Powell already knows a hint in terms of how it looks like the data is starting to crack in terms of which way for jobs. So I'd be looking for any kind of hints from Jerome Powell on, hey, does he potentially know how that job report is going to go on Friday? After all, they released the report at 5:30 a.m., California time, so I guess that'd be 8:30 in the morning Friday. So nobody's actually compiling that report Friday morning. The report's going to be fully compiled by, probably, frankly, now, but technically tomorrow. Which means there's a good shot Jay Powell already knows what's coming down the pike for the Friday jobs report. So that's why I say any hints he gives us today could be very interesting. I'm looking forward to that. Trump now also saying he's negotiating with India now, and we'll see what happens. You'll know at the end of the week. All right, Donnie T. All right. Donnie dangling the carrot. This is the last set, or from the last meeting that we had, June 18th, just a mere 4 weeks and 12-ish days ago. In this, we noticed the write down in GDP, yet highest inflation, which is sort of like a stagflation light. It's not really like the economy's crashing off a cliff and prices aren't falling. It's just a sign that we've got some pricing pressures left and the economy's humming along. Hopefully nothing has changed from this tune over here. We don't expect a unanimous Fed today, by the way. The decision, which comes out in 8 minutes, will probably be you'll probably have a couple dissenters who want to cut rates now. One of the reasons you would see this, like with Mr. Waller especially, I think he'll be one of them. Usually, as well as Michelle Bowman, I think both of them are trying to push for a job as Federal Reserve chairperson. I guess it could be chairwoman, right? And so by aligning with Donald Trump, hey, yeah, see, I'm already voting to cut rates. Let me be the Fed chair. And I'll get us all set up. Well, then all of a sudden, you've got a potential somebody who's already putting the votes in the way Donnie T wants it, right? Nobody knows if that's exactly what the case is going to be, but I find that very interesting and very much a potential. So another thing I would say is, even if we get two dissensions, people who want rate cuts, it doesn't really matter because the market's pricing in roughly 1.7 to 2 cuts by the end of the year. Whether those cuts come, with a 50 in September, which would be probably a sign that there's some kind of problem in the economy, or it's, a November, December 25, or it's a September 25 skip in November. and then a cut again in December. I don't know that any of that really makes a big difference. I think people just, markets might be more interested in just confidence on those job numbers. So as long as the job numbers are good, the interest rate's just not going to matter. We always talk about these long and variable rate lag or long and variable lags with the Federal Reserve. And, we've had high interest rates now since 22, so we're talking about 3 years. You'd think we'd really start seeing these long and variable lags. There are certainly some cracks in the economy that we could look to, but then again, no economy is perfect. So, and that's not to, cast aside some of the slowing. There's no doubt economic growth is slowing. But does that mean we're going to fall off a cliff? Well, hopefully not. I mean, if AI keeps going the way it does, which I think it's sort of, I see it as sort of like a virus that spreads through companies, a lot of people are going to lose their jobs. But that could lead to, to a 10-year flat cycle where stocks are like flat or down for 10 years because, unemployment has to reset to this insane high of 10 or 15% or something crazy. And it takes a very long time for you to actually create AI useful jobs. In other words, jobs that can coexist with AI. Right now, I feel like there's more likelihood of replacing. Federal Reserve estimates for cut today, 3.1%. It's probably zero. The Fed doesn't like to surprise markets. They will usually do what the consensus is, which is a 96.9% chance of no cut. September 17th has a combined 60.7% chance of a cut. And then, of course, remember, this is the last FOMC meeting note right here, which shows us that more members joined the slower GDP camp, but nobody was negative in GDP. So none of these folks at the Fed are really seeing a recession. And the only way we would see some kind of concern pop up is by negative voting over here in GDP. But none of them vote negative in GDP. Here's the real change in GDP. You can see the spread in the forecast here. The zero line is right here, where sort of this gray thing is that I'm making. They're all above it. So we got our blank bingo board ready. We'll start filling this out in more detail once we actually get, we'll just throw in our freebie, Powell on time. That'll be a freebie. But we'll start filling this in more. Remember also, last time we had get your coupon code at me, Kevin, get your lifetime access to the alpha courses, Trumponomics, real estate course, live streams, etc. This was literally last time. No cut today. Yep, that's exactly what we're expecting today. Higher for longer, probably through 2027, absent, some jobs pain. That's why I'm looking for some kind of forecast from JPOW. I think the 10-2s this morning were at 45. So you're actually seeing less stress in the, it's back to 47. That's funny. That's literally what it was at the last Fed meeting. The stagflationary suggestion wasn't great in the set. Slightly higher inflation expectations, stable unemployment expectations. That's the key. As long as jobs stay up, we're fine. And the market should see this as hopefully a clearing event. I mean, this is the uptrend line for the Qs, which is part of our Nike swoosh. Here's our Nike swoosh we've been talking about since 2022, mind you. The Nike swoosh is very well intact right now. And this is actually the upper portion of that line. You can see we sort of bounced on it a few times today. Probably also just driven by this continued strength in Nvidia, which is really impressive. I mean, now you're at, what, a 4.5? No, this still says 4.37. I don't think this is updating as much as it should. But, basically $4.5 trillion company here, up 2% on the day. I mean, if every 2% on a $4.5 trillion company is like a $90 billion company. Nvidia literally farts $90 billion companies. It's kind of crazy if you think about it. And it's just a random day-to-day, plus or minus 2%, is creating or destroying the existence of $90 billion entities, essentially. It's kind of wild. Oh, wow, look at that. Tesla's now consolidating just under the 318 line. Critical lines talk about a lot in the course live. You know, for example, I've been talking about the lines with AMD for I feel like months now, and how low this peg has been. So really impressive moves. Supermicro still on its way to 71. It's at 61 right now. Notice how nobody's talking about accounting issues anymore. It's like all that went by the wayside. You know, Circle and CoreWeave still struggling following their pop-offs, kind of bleeding down. Both of them obviously performed well from IPO, but hey, you know, it's nice to have someone like Nvidia come and say, hey, we'll buy 250 million of your stock and every time you go under $40 a share. Donald Trump just said, moving along well with China. It's going to work out well. Going to have a very clear deal with China. We're also negotiating with Harvard now. We would like to settle. We'll see what happens. You mean Trump, you don't want to go all the way through the court process? You just want to kind of bully him into a settlement? All right. I mean, that's kind of the MO, right? It's the same thing with the latest. All right, here we go. Fed decision now imminent. And we are at Fed leaves unchanged. No rate cut. Recent indicators suggest growth of economic activity moderated in the first half. Inflation remains somewhat elevated. Federal Reserve suggests growth of economic activity moderated in the first half. Inflation remains elevated. Unemployment rate remains low. Labor market conditions remain solid. Governor Waller and Bowman dissented. Called it. Absolutely freaking called it. That should have been on the bingo board. What a shocker. What a shocker. Bowman and Waller, job application, have dissented, preferred 25 BP cut. Fed chooses not to cut. Not a surprise. And then at least in the memo, there is, just talk about inflation being somewhat elevated. And then we have talk about unemployment rate remains low, labor market conditions remain solid, and let's see here, growth moderated in first half. Growth moderated in first half. Big deal. That's kind of like what they said in 2007 as well. Oh, it's just moderating, you know? Anyway, so Jay Powell will now be out in 29 minutes. And let's go actually get the statement here. All right. So take a look at the statement here. Federal Reserve issues FOMC statement. Although swings in net exports continue to affect data. Mind you, this is a GDP issue, right? So I'm going to make a note because I'm kind of like jotting now over here. You know what? Let's actually just change the color. Let's go with green. Okay, green will be green equals July 30 update. Red was June 18th. So, okay. All right, whatever. Oh God. Oh, Kevin. June 18th. There we go. And then we'll go July 30th. There we go. July 30th in green. Okay, this is literally as expected across the board. What is interesting though is the Fed's basically throwing an asterisk on, Trump's GDP claims, as they should. Fed appropriately, you know what, let's, we could also, yeah, that's fine. Okay. Let's keep looking at this here. So, Fed suggesting net exports keep, how should you put it, affecting, I guess, the GDP data. Not a surprise. Recent indicators suggest growth moderated in the first half of the year. That's not terrible, but certainly not bullish. Unemployment remains low. Inflation somewhat elevated. This is what we wrote down. Seek to maintain maximum employment. Goal is the 2% objective for inflation. Maximum employment is the goal. No surprises here. And then, of course, here were those who voted for a lower rate and a reduction of 25 basis points, Bowman and Waller, as expected. So far, big nothing burger here, big deal. I do wonder how markets are reacting. I'm actually surprised there's a red candle and like an increase in volume here. This is really not a big deal, and we should have expected this. But then again, these candles only really represent about 5 basis points, so it really doesn't mean anything on the day. I mean, look at the the hour chart or the 30-minute chart. This doesn't even show up, so not a big deal. SoFi, by the way, almost fully recovering its liquid or new share issuance there. Donald Trump obviously complaining about the Fed not cutting rates. Then Jay Powell will be speaking in 25 minutes. This is, I noticed there's no real asterisk over here other than uncertainty remains elevated, and they're attentive to both sides. So it's not like anything really developed that changed what we should be paying attention to. So I'll write that down. Letter does not suggest or imply any potential red flags, which is also bullish, right? So keep that in mind. It is like the Fed not sending us red flags, bullish. Jay Powell last time did send us notes on, hey, we're concerned about, the potential that you have this sort of V shape or more like a U in employment. And the way this works, this is really his signal about AI. What if AI causes job losses and then in the future it causes gains? But the time difference between, T0 and T1, let's say, time now and time future, the time difference here could be a decade. Like we don't know, right? And Jay Powell started giving us that as a red flag to pay attention to, and I think it's an appropriate one to pay attention to. I actually thought it was interesting. The more we look at sort of what we built with House Hack, the more we look and say, okay, first of all, AI and this latest AI revolution is so great from what we can do with our our internal MLs, the machine learning we've built for wedge finding and that to turn it into a SaaS business, hopefully towards the end of the year, beginning of next year, probably beta at the end of this year. Yeah, but also just in terms of replacing people, like it is if and this is something for you to know too, if you're working for somebody, like if you're an employee and the extent of what you do is put stuff into GPT, realize you're replaceable. That's the scary thing. What makes somebody valuable is that they can think above and beyond GPT. The unique perspective or the efforts of connecting the dots outside of GPT. And this is something that Jay Powell signaled to us. He gave us the warning in the last Fed meeting. He said we could see jobs disappear. And history says that we always end up creating more jobs. There's just a question of what the lag is between the two. And so that is a bit of a signal from the Fed. And the more I look at it, the more I'm like, wow, yeah, anybody who really subsisted at their job that's ever worked for me by just plugging stuff into GPT has gotten replaced either by GPT or just gotten fired because they're not needed anymore. So it's kind of interesting. Like, I think everybody should think about that. The more at your job you use GPT, the more replaceable you are. So you almost have to be like, all right, how do you manage GPT without it replacing your unique perspective or output? It's one of the reasons why I don't run any of like the news or the research I do or financial statements through GPT, when I make videos, because I want you to have Kevin's perspective. If you want the generic GPT perspective, you could just as easily plug it in too. But that gives you generic perspective. So, all right, let's go grab some of our bingo board here and do some planning. So I'm gonna throw on the bingo board this time a little bit of a unique one. We're gonna talk about AI risk to jobs. We're gonna, see if this discussion comes up again. Comments on, right? AI risk to jobs. Then we also, obviously we expect Powell to be on time. What we'd like to see is some form of setup for, what's it called? Some sort of setup for a September cut. Yeah, setup for September cut setup. Okay, very good. So somebody here says, I do think it'll take companies a while to adapt. Yes, Solid Nate, I agree with you. It will take a while, but that's where what's so interesting, if you think about it, is, you know, the AI, like neural nets, you know, popular from like 2014 to 2020, call it, was sort of like your neural net revolution. Doesn't really affect jobs. You know, then you had the AI boom in 23, but I think the actual impact of like that T0 is probably more now in 2026, right? That's probably where you see more of the impact of that jobs hit. And then really the job creation from AI is probably more like 2035. You know, we'll call that T1. That would be my guess. And so that's why I think we'll have some comments from Powell on this. We think this will be interesting. September rate cut setup would be very bullish. So we're going to call this the bullish column. Okay, so we'll have a bullish column here. And then we'll have a, we'll call it the bear column over here. And you know what, we're going to do that from now on. We're going to see if the bull or the bear gets bingo. So that could be interesting. So the bear column would be comments on AI risk to jobs, tariffs affecting core prices, and may lead to more inflation, as well as rate delays would be the implication there, right, with this. So the comment on potentially rate cuts this year, bullish for 2, at least, right? This would be good. Obviously, thinks he's going to say, he's going to use the phrase meeting by meeting. We're going to hear data dependent. We're going to hear, I mean, these are like our generics right here, right? This is like going to get generic milk. It's just like everybody's got it, all right? Let's put in, you know, independent of politics, no comment on Trump. Okay. So let's see here. Just close that Fandoria. Let's see. Oh, anchored inflation expectations is a good one. Yeah. Inflation expectations remain anchored. That's true. That's a good one. I also do like good afternoon. That one's always fun. Good afternoon. What about, you know, maybe we could throw in like a not my job. That's always a good one. Okay. So let's see. All right. Okay, let's listen to them for a brief moment here.
Listens. I'm sure you talk to people all the time about this. Even if today Jerome Powell gets on stage, takes a question from Steve Leisman, sounds very dovish, does the bond market move on that? Because the bond market maybe has its own view on where things are going.
That, sir, is an important and cogent question, if I might, and I'll tell you why.
Cogent.
In our Fed survey, Brian, we have 100 basis points of the average respondent coming off of the Fed funds rate, and only 13 basis points coming off of the 10-year. So the 10-year is seen next year, on average, at ending 2026 at 4.25. You have a whole lot of things going on in the long end of this market. The thinking is that there will be a tremendous steepening of the curve up to maybe 75 or 100 basis points, but that you do not get the relief that people are seeking on the long end, which, as the Wall Street Journal editorialized this morning, are the rates that matter for the economy.
Sure.
All right. Good.
That's basically the way you get the long end to come down is a recession. I hate to say it, but that's how you get the long end to come down. because people don't know how long that pain is going to last. And so they go to the long end for safety. And it also gives you the greatest capital gain on the upside.
The White House, it seems, a trio of fact sheets just being released saying the president has signed some executive orders on trade, formalizing some moves, some of which he had threatened, some of which are new. The first is the president says he's going to be revoking entirely the de minimis threshold for all packages coming in from abroad. It'll be taking effect at the end of August. Now, this is something
Temu just died.
like Shein and Temu. Amazon could be exposed here. It takes away.
Okay, that's what we're going to call it now. We're going to call it Temu.
Is worth less than $800 to come in.
Amazon and Temu.
As effective August 29th, all of those packages will have to face tariffs based on where they're coming from. Those country-specific tariffs will start to take effect. So that will be a big change, Brian, when that one takes effect. The second fact sheet says that the president now has formally signed that 50% copper tariff into law. That's something, or into executive order, I should say. That comes as a result of that national security investigation. He's been threatening it for a few weeks now, but we hadn't yet seen it formalized. Now he says it will be.
Yeah, Temu is the knockoff version of Temu.
About 19%, it looks like. So another big impact there. And then the third one, Brian, is that he also added a hefty new tariff on Brazil, something else that we had seen threatened, hadn't been formalized yet. He added 40% tariffs on top of the 10% Brazil tariffs that were already in place. He says he's declaring an economic emergency in order to do this, and that will take effect. Again, not a huge trading partner for the U.S., but there are some goods likely to see some big impact there, things like orange juice, coffee, some metals as well.
And how about certain planes? I wonder how ERJ stock is moving on that one. Let's see here. Okay. Jizzle. That's what we'll call it. Choke. Look, it's hanging out on Kevin's line, and then it just hangs itself by Kevin's line. Oh, that's gruesome. Don't do that. Don't even joke about such things, Kevin. How could you do that? Hey, by the way, did you know the channel is sponsored by life insurance? You can get in as little as 5 minutes by going to metkevin.com/life. It's the same life insurance Lauren and I have. You can sign up in as little as 5 minutes. Aw, Kevin. And then come all the comments. How could you? That's diabolical. Okay, suck the wiener. All right, so let's get back to our bingo board. So we got the bullish column, we got the bear column, and we've got we heard about these Brazilian tariffs. We'll just sort of like make a little note about this on the right over here. So these 40% Brazil tariffs. Not great for Embraer stock. Then you've got the ban of Chinese. Well, I should say. I mean, it's basically what it is. Ban of de minimis exemption, which is not great for Temu and the other ones. And then, of course, you know, really, it makes you wonder too. Like, what happens if? I still wonder if you can get courts to come in and say, like, oh, the tariffs are illegal. That'd be very interesting if that ends up happening. But all of those tariff court cases just keep getting kicked down the road. So Donald Trump gets the beauty of, or the privilege of time, I should say. Okay, so back to our bingo board here. So we're starting to get these dissents. We got 2 dissents. He's going to get asked about these dissents, I would guess. I would say it would be nice to get Powell to answer, but he's not going to because he's going to forecast unity. So I'm going to make that a 2-part bingo question. We're going to go, so we'll put it over here about, so we'll say asked about two dissents. Powell suggests close unity, just slightly off on timing. You know, some just want a bit more data. You know, he'll do something like that, which is just a very diplomatic way to really blow that question off. So that's my take here. He'll get asked, but he's just not going to provide an answer on that. Then there's a clear and present danger of slower growth while the risk of inflation is more speculative. and likely a one-off event. That's Waller. So I think that's also a chance, is that Powell ends up getting asked about this being a one-off set of inflation that we end up getting from tariffs. The problem with assuming that is what we really do is we assume that the tariffs are going to be done, right? So tariffs one-off, Powell will likely say, we don't even know where tariffs will end up at this point, or like which will stick, right? So it's really like people want to so badly point to current inflation reports and say, hey, there is no inflation from tariffs. But the reality is some of the earliest of tariffs are just now going into effect. We don't really have a tariff effect yet. So it's impossible to claim there's no tariff inflation because the tariff effect has not hit yet. So we'll probably see some phrase like tariff uncertainty or tariff negotiations make the timing of tariff impacts highly uncertain. Must stay vigilant, right? So in data dependent data, but a lot of data is what they want. And the reason they butter it out is because it's not like we got all of our tariffs assigned on April 1st. We've had 3 months of low-ish, even though some of our core goods have started skyrocketing, inflation, and then it's done. So we just don't know what all the impacts of this stuff are going to be yet. That's the harder part. Okay. So what else we have here? We've got... Kevin needs to be in charge of the Fed. Well, you know we have something to say about
Kevin
that.
is very talented, but I don't know if it's going to be him, but he's a very talented guy. Kevin's somebody would consider. Kevin is fantastic, too.
Kevin is much more interested than most people, by the way, in the balance sheet.
Yeah, you know, just got to say. No, Epstein won't be brought up over here. This isn't where Epstein gets picked up. And if he's asked about a replacement, new Fed chair, he'll also just, he'll punt it. I would bullishly, again, like comments on 2 rate cuts. And then I want, job market is stable would be very good. Hints, basically. On the bear column, we could say some weakening in jobs. But I don't think he's going to say that it's worsening. So I think he'll say, but stabilizing. Right? Stabilizing or stable. Because I don't think we see a labor market that's super weak. We got the not my job. We've got, what else here? Housing. Housing services, not really something they talk about much anymore. It's not a significant contributor to inflation. Yeah, we could throw in for giggles, purple tie. I guess we could say housing is not a significant source of inflation now. But that's fair. Is the Fed worried about deflation? Well, deflation occurs in recession. So, of course, their goal is to prevent that. Chinese are buying less iPhones. Yeah, I heard Apple closed one of their first, had one of their first closings ever. I thought that was surprising.
Welcome. Nice to have you. So you want to talk about lovemaking, right?
Yeah, we do. Let's see here. Trump's very concerned about housing stuff. No real, professional, I feel like, cares about what's going on with housing sales data. I get it. Volumes are down. But it's not indicative of what's actually happening in the real estate market. Unlike, when we get sort of data for the stock market or earnings, right? Housing, the housing numbers that stock market people look at are the total opposite of what you should be paying attention to. But it's a very different brain that you need for real estate, and that's not to say one type of brain is bad or smarter or whatever. It's just The real estate market is defined by you getting your ass out there, going to open houses, visiting realtors' offices, watching properties hit the market, seeing how many people are showing up, seeing how fast they're selling, how fast are we going into escrow relative to what the comps say that should be going in escrow for, how many offers did it get, how many multiple offers did it get, are people removing contingencies? These are very hard, sort of almost intangibles that take 3 months to show up in actual closing data. By the time you're getting data from the Wall Street Journal on real estate, it's too late. Like, you've already gotten screwed. I hate to say it, but that's all right. All right. Oh, yeah. Is somebody going to ask about the Fed building? I mean, somebody will ask about it. Fed renovation. Powell defends not including third building. I think that's an easy leg for him to stand on. That completed in 2021, the Martin building. I wouldn't be surprised if that comes off and it'll come up, and it'd be a great way for Powell to blow off that question, because he could like answer the question by not really answering the question, which is kind of interesting. Powell will not resign. Like, guaranteed, no chance Powell resigns. I can't believe I'm writing this. Okay. But I'll write it on the bullish column. He's going to mention the Grateful Dead again. Yeah, and riding his bike. Honestly, I mean, hey, if he's talking about Grateful Dead and riding his bike, you know, that's probably a good thing. Let's see. Powell is on the Epstein list. Stop. No. Trump will announce he's fired mid-speech. Yeah. That would be an interesting time to do it. Imagine, like, Steve Leisman, you know, puts his glasses on. Like, just imagine. Mr. Powell, we're just getting word that Donald Trump has just announced he's firing you. What say you? You know, with the hunchback that Leisman does when he's reading his question. Oh, man. Okay, we got to put that one down. Steve Leisman hunches over when he asks question of Powell. Okay? So I need one more bull and 2 more bear pieces. Let's see here. Let's go with another bear. I mean, really the only thing bearish would be jobs. AI risk to jobs, weakening in jobs. Oh, well, I guess you could say bullish would be wage pressures are not a significant source of inflationary pressure. I agree with that. So 2 more bearish things would be maybe you could say something like valuations are very high, you know, but they like always are. And then equities, you know, I don't know that we'll get that, but equity valuations are very high. Okay, I doubt it, but whatever. And then we have anchored inflation expectations. How about something else that would be bearish would be delay in rate cuts due to tariffs. Oh, this would be badass if he had the balls to say this. He might. Delay in rate cuts occurring due to tariff negotiations, which could lead us to be too late in cutting, in responding. Ooh, wouldn't that turn the tables? Oh, that'd be juiced. Oh, that would be so juicy. Yeah, okay. So that would be clutch. And then what else do we have here? By the way, look, if you go, I almost totally forgot to mention, if you get the Meet Kevin membership before the price goes up on Friday, use coupon release the files. You can see it applied right here. So we should put like a little green thingy here. We'll put it in the Powell box. Coupon code is release the files, and then price goes up Friday night. Price up Friday night. Ah, there we go. There we go. Simple. All right. MeetKevin.com. Get that alpha report every morning. Get my perspective. And I purposefully don't use AI. Like, I feel like you almost have to pitch that now, right? It's like, no, man, you're getting Kevin's perspective. You're not getting some generic bot that everybody else is using. Because if everybody else is using the same insight, there's actually no alpha if you think about it. So what's the point? It's gotta be unique perspective. All right, so Fed meeting. We are all waiting for the Fed. All right, Powell, it is now 11:30. He's usually on time, so he should be walking out any second now. 24 seconds after. Where's Powell? Where's my boy? Where's my boy? Where's my homie? Boy, you better be on time, man. Oh. There he is.
Very much. Sorry to cut you off. Here is Jerome Powell.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment
He did say good
and
afternoon.
stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer-run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, Most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5% and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer-run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
He kind of said.
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive.
Okay.
Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment. Financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate.
That's not
All that said,
good.
There's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So just to follow up, by coming months, does that include
So
the
no
possibility
September unless
you'll be getting
jobs.
essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right. We do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration.
Did he say we haven't made no decision about September?
Make our decision at the September meeting.
Okay, so that's bearish
Thank you, Mr. Chairman.
for cuts.
You took out the word or the notion that uncertainty has diminished from this statement.
There are the glasses.
Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea of what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still, you're right. It's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still a ways away from seeing where things settle down. We are clearly getting more and more information, and I think at this point, people's estimates, our estimates, outside estimates of the likely, effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge. But it feels like there's much more to come, as well, looking ahead.
This is like a middle finger to Trump.
Hi, Mr. Chairman. Neil Irwin with Axios. This morning we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now,
Good question,
given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market, what you see is, by many, many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable, which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So
layoffs.
The labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So we of course, will be watching that carefully.
That's a really big statement there. It's basically saying, yeah, we're kicking people out of the country with lower immigration, but there's also lower demand. Both of those things are a sign of a slowing economy. Good comment there by Powell. Pay attention to that. That's a big one. Layoffs tick up. It's over. It goes fast.
The June forecast.
We talk about that a lot in our Alpha report in the mornings. Remember, use coupon code release the files before the price goes up on Friday.
And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody and also from a dissenter is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table where people were, thought carefully about this and put their positions out there.
Just off on timing, baby. Say
As
it.
I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think all around the table. In terms of, you asked about the June SEP, I wouldn't, that you're right, that's what it says, and that may well, I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one. So I'll just say that, we haven't made any decisions about September. We'll be monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market?
So let me say, my own estimate is modestly restrictive, and there are a range of views of what the neutral rate is at this moment for our economy, and so others may say it's more restrictive or less restrictive even. We're going to be, at some point, when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, we've derived with great confidence the neutral rate and that is our destination, because really we understand that no one actually knows what the neutral rate is. We know it by its works, and that will be how the way the economy reacts over time to slightly looser policy.
Okay, quick note on the Brazil 40% tariffs. Embraer literally exempted. Thank goodness. Okay, we need those regional airliners.
Over the last few months about the inflation generating and price pass-through process. And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in
prices
goods
right here.
prices,
we wrote it down.
Is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days.
Yeah.
And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is, substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price, and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. It's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer, but the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast. We think we have a long way to go to really understand exactly how it will be. So that's how we're thinking of it right now.
It's not good.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic, expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates. We haven't reacted to new inflation, but I mean, I wouldn't insist upon that. But I don't think. I think the base case, as I said, a reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation, because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. We want to do that efficiently, though, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Damn.
Michael McKee
He's really
from
kicking the
Bloomberg
can down the road.
Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say when you think that, the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow up, what do you, well, I don't want to put this in terms of you and the president, so let me ask it this way. Do you have concerns about the cost to the government of keeping rates elevated for longer in terms of interest rate charges?
Yeah, no, that's, we have a mandate, and that's maximum employment and price stability. And it is, it's not something we do to consider the cost to the government of our rate changes. We have to be able to look at the goal variables Congress has given us, use the tools they've given us to achieve those goals, and that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central bank does that, and it wouldn't be good for, if we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.
Victoria. Hi, Victoria Guida with Politico. When it comes to the renovations of the Federal Reserve's headquarters that the administration has been looking into, do you see their interest in that issue as being directly tied to the president's push to get you to lower interest rates?
Yes.
Not for me to say. I will say we had a nice visit with the president.
No comment.
It was an honor to
I'll
host
check
him.
that off.
It's not something that happens very often at the Federal Reserve to have the president come over, let alone to visit a building. But it was a good visit.
Are there any aspects of the project that they've raised that you see as making you reconsider any aspects of the project?
So, this project was hatched and conceived almost a decade ago now, and we went through the very long process of clearing it through historic preservation at the National Capital Planning Commission, and a lot of back and forth there. It was very constructive. We started out to do the work, and we're very well along on that work, and I was quite pleased to have the president say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
By the way, we have a hiring post out. Maybe we can help the jobs report. It's pinned to my Twitter, @RealMeKevin, if you want a job, especially if you're a newer attorney or into AI.
The fact that inflation hit 2.1% last September and has bounced higher since. Why do you think financial conditions are restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation sometimes early in the year, and then inflation turns lower, and a lot of that may just be an artifact. So that's why we look at the 12-month numbers. I think inflation is most of the way back to 2%. There are things like the catch-up inflation. So, for example, all the insurance costs that they're only now going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through. In addition, now we have 3 or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate kind of inflation that isn't the tariffs. We're always going to be dealing with all of inflation. But the composition, as I mentioned, has really changed. And you know, if you go back to the last couple of years, it was all about services inflation, which was being very sticky. Now services inflation is coming down nicely.
Yep. Goods
inflation was well behaved before, and now goods inflation is going up. So the story has really changed. That's partially because of tariffs. It's also partially because we had restrictive policy in place, and we've seen that the result of that gradually work its way through the services economy.
Okay, the other thing I wanted to ask is, are you comfortable that BLS can continue performing their mission effectively if they take an 8% reduction in headcount and authorized spending as the administration has proposed?
I'm not going to comment on the administration's proposal. I do think, as I've said, I think that we're getting the data that we need to do our jobs, and I think it's really important that good data helps not just the Fed, it helps the government, but it also helps the private sector. You know, people in the economy, they use this data a lot too. So it's quite important for our economy, and certainly for the Fed's work and other government agencies' work, that we continue to get better at data. That's what we've been doing for 100 years. We've been getting better and better and better. It's very hard to accurately capture in real time the output of a $20+ trillion economy. And the United States has been a leader in that for 100 years, and we really need to continue that, in my view.
This is disappointing.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. How concerned are you with the data that we're coming in, showing no significant upward trend in inflation over the past 6 months, that the wait-and-see approach for inflation is actually giving...
He's going to totally counter that, by the way. He's going to go, what are you talking about? Like core goods going up, whatever.
How concerned am I that say that again?
The wait-and-see approach is giving...
The wait-and-see approach, what do you mean by that?
For cutting rates. You're waiting to see if the tariffs will affect inflation. So it's a wait-and-see approach.
They already are.
So that, that's where policy's restrictive. When we start cutting, it'll go toward neutral.
Okay. This delay, though, where you're saying there's a one-time price increase for tariffs, which possibly could lead into bigger inflation or more inflation. Is that giving companies cover, though, to raise prices?
Well, what may be giving, it's not our policy stance, what may be giving some companies will certainly be taking advantage of the fact of the tariffs and all of the discussion of how they're going to, companies will raise prices when and as they can. And you saw it famously in the first administration of President Trump during those tariffs. Washing machines were tariffed, but dryers weren't. But what do you know? The price of dryers went up too, just like
both went up. Yep, he's right.
So companies will often just they'll cross the street in a group, if you know what I mean. Mm-hmm. That'll happen. We don't see a lot of that. I mean, what we see now is basically the very beginnings of whatever the effects turn out to be on goods inflation. And I'll say again, they may be less than people estimate, or more than people estimate. They're not going to be zero. Consumers will pay some of this. Businesses will pay some of this. Retailers will pay some of this. But we're just going to have to see it through.
And just to follow, if I could, some additional tariffs have been in place since February, and things really haven't broken yet with the economy. So how do you justify to somebody who's looking for a house, who's facing a 7% mortgage and maybe can't afford those rates? How do you justify that?
Well, so the housing is a special case, right? We don't set mortgage rates at the Fed, right? We set an overnight rate, and the rates that go into mortgages are longer-term rates, like Treasury rates. It might be 30-year rates. It might be shorter than that, but it's not the overnight Fed's rate. It's not that we don't have any effect. We do have an effect, but we're not the main effect. There are other things, though, going on in the housing sector, and one of those is just there's kind of a long-term housing shortage that we have. We haven't built enough housing. This is not something the Fed can help with. But
there goes the NASDAQ.
Even after things normalize. So I think the best thing that we can do for housing is to have 2% inflation and maximum employment, and that's what we can contribute to housing. There are lots of other jobs to do for the private sector and Congress, but that's what we're trying to get to. We've made a lot of progress toward that. We have a very good labor market right now. Inflation, we were very close to 2%. We're seeing some goods inflation move us away, but so far not very far away.
Hi, Chair Powell. Thank you. Well, can you give us a little more about what kind of economic data does the Fed need to see before you'll be ready to cut? I mean, do you need inflation back nearly to target? Are there other things in the pricing that you look for? Do you need to see weakening in the job market? What kind of things are you looking for?
I mean, ultimately, it could be any of those things, right? But you know, if you saw that the risks to the two goals were moving into balance, if they were fully in balance, that would imply that you should move toward a more neutral stance of policy. This is the special situation we're in, which is we have two-sided risk to both of our goals. When we paused, inflation was above target and the labor market was pretty good. So you know, that was a time when policy was restrictive when we paused. And to be restrictive is to be supporting a return to our inflation target, right? So as the two targets get back into balance, you would think you'd move in a way closer to neutral, and that the next steps that we take are likely to be in that direction. What will it take? You know, it'll be the totality of the evidence. As I mentioned, there's quite a lot of data coming in, which before the next meeting. Will it be dispositive of that? You know, it's really hard to say. We don't make those decisions right now, so we'll have to see.
Well, I guess just in terms of inflation, though, for example, like some people would point to if it remains only in goods and it doesn't bleed over to services, then maybe that's evidence that the tariff effect is going to be a temporary one-time thing. Is that kind of thing affect your thinking, or do you just need to see the number come down
I think
closer to 2?
We'll look at everything. You know, it's, as I mentioned, you know, a pretty reasonable base case is that this will be a one-time price increase. And in the end, we'll make sure that that's the case. We're just trying to do that efficiently. And efficiently means getting the timing right so we don't, again, if we cut rates too soon, maybe we didn't finish the job with inflation. History is dotted with examples of that. If you cut too late, then maybe you're doing unnecessary damage to the labor market. So we're trying to get that timing right, and that's effectively what we're doing.
Claire Jones, Financial Times. Just a question on
This
the
sucks.
dollar. We've seen it decline quite heavily this year. I was wondering if there's been any discussion about that at the meetings and to what degree that may be complicating your attempts to get inflation back to target. Thank you.
So this goes back to the division of labor between the Fed and the Treasury, as you I'm sure know, and you know the Treasury only speaks to the dollar. It's not something that's been a topic of you know, major discussion at all at the Fed. I wouldn't say it doesn't come up. If the transcripts, when they come out in a few years, they'll probably reflect some mentions of the dollar, but it would never be a major focus.
And just to follow on, if I may, to Andrew's question, I think the amount of imputed data in CPI now is up to 35%. I mean, is there any discussion of that as well? Is there any consideration of looking at alternative measures, data scraping and so on, in order to just ensure you've got a good read on what's happening to prices in the U.S. economy? Thank you.
You know, we're monitoring the situation. We do, of course. I mean, as you know, during the pandemic, we looked at a whole lot of new kinds of data. People are looking at big data sets that you can get from all sorts of places, and we do all of that. But at the same, we really need the government data. Really is the gold standard in data, and we need it to be, you know, to be good and be able to rely on it. And we're not going to be able to substitute for that, but you know, we'll have to make do with what we have. But I certainly hope that we get what we need.
Jay O'Brien.
Hi, Mr. Chairman. Jay O'Brien, ABC News. President Trump has obviously invoked your name a lot. He has personally pressured you. Are you concerned the way that conduct might impact the Fed's independence going forward?
I'll just say that, so I think that having an independent central bank has been an institutional arrangement that has served the public well. And as long as it serves the public well, it should continue and be respected. If it didn't serve the public well, then it wouldn't be something that we should just automatically defend. But what it gives us and other central banks, what it gives you is the ability to make these very challenging decisions that in ways that are focused on the data and the evolving outlook, the balance of risks, and all the things we talk about, and not political factors. And so governments all over the advanced economy world have chosen to put a little bit of distance between direct political control of those decisions
Data. Thanks.
and the decision makers. So if you were not to have that, there would be a great temptation, of course, to use interest rates to affect elections, for example. And that's something that we don't want to do. So I think that's pretty widely understood. Certainly it is in Congress. And I think it's very important. I'll just say that.
Maria Eloisa.
Afternoon, Sir Powell. Maria Luisa Capurro from Bloomberg News. You mentioned a slowdown in consumer spending, and I wanted to see if you could walk us through what was the discussion with the committee around that. We've seen delinquency rates rising for upper-income households. How do you see that evolving in the next few months, and how much of a vulnerability that is for the economy going forward?
Consumer spending had been very, very strong for the last couple of years, and had repeatedly, forecasters, not just us, had been forecasting it would slow down, and now maybe it finally has. So I would say, if you talk to credit card companies, for example, they will tell you that the consumer's in solid shape and that spending is at a healthy level. It's not growing rapidly, but it's at a healthy level. And delinquencies are not a problem. You mentioned high-end delinquencies. I don't know what to make of that. I read the same thing. But so generally, if you look at the banks, and when the banks talk about in their earnings calls, the performance of credit has been good. So essentially, you have a consumer that's in good shape and is spending, not at a rapid rate, but it's true. And it was, again, right in line with what we expected. The GDP data that we got this week. And I think it's still a little bit difficult to interpret because you have these massive swings in net exports, which may also be affecting, some of that can affect consumer spending as well. Look, it's one of the data points that we pay most careful attention to, and there's no question that it's slowed. And we're watching it closely, but we also watch the labor market and the performance of inflation. Those are our two variables that we're assigned to maximize.
And just to follow up on what my colleagues were asking about the dissents, Governor Waller said that the labor market is on edge, and he was pointing to weaknesses on the private sector. I was wondering, you've said that the main number to look at is the unemployment number overall, but what was the discussion about the state of the private jobs market?
So I'm not going to talk about any individual's, any individual's comments. I wouldn't do that. But I think what we know is that private sector job creation, certainly in the last report we'll see on Friday, but had come down a bit. And if you take the QCEW adjustment seriously, it may be even lower, maybe close to zero. But the unemployment rate was still low. So what that's telling you is that demand for workers is slowing, but so is the supply. So it's in balance. Oddly enough, you've got a very low unemployment rate, and it's kind of been there for a year as job creation has moved down. But also we know that because of immigration policy, really, the flow into our labor force is just a great deal slower, and those two things have slowed more or less in tandem. If you look at things like I mentioned, quits. Look at wages. Wages are gradually cooling. Look at vacancies to unemployment. Those things have been pretty stable they haven't really moved a lot in a full year. So I think if you take the totality of the labor market data, you've got a solid labor market. But I think you have to see that there are downside risks. You don't see weakening in the labor market, but I think you've got downside risks in a world where unemployment's being held down because both demand and supply are declining. I think it's worth paying close attention to it, and we are.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. One more question on the
lack of unanimity in today's decision, the two dissents. Was there talk during the meeting? I know you're not going to talk about exactly what individuals said, but in general, was there talk during the meeting of cutting rates, and what was the case against that at the meeting?
Sure. So, we have an economic go-around where people talk about the economy, and then that's yesterday, and then today we have a monetary policy go-around. All the way around the table, everyone gives their views. So the discussion around policy was, the majority view was still what it has been, which is that inflation's running above target, maximum employment is right at target. That means policy should be a little bit restrictive, somewhat restrictive, because we want inflation to move all the way back to its target. So that's where people have been and still are. Two of our members felt that the time had come to cut, and that they, for the reasons that they're going to express. I won't tell you the reasons. They'll issue some kind of a thing in the next day or so. But that's the story, and I would say, well argued, very thoughtfully argued all around the table, good arguments, and it's a situation where, an unusual situation. The economy is in good shape, but it's an unusual situation where you have risks to both your employment mandate and your inflation mandate. That's the nature of a supply shock. And it's probably not surprising that there would be differences and different perspectives on that, as well as different views of where the neutral rate is, so that different views of how tight policy is. So we have those. I will say what you hope is that people, explain their positions very thoughtfully and clearly, and we absolutely had that today, all the way around the table. I would call it one of the better meetings I can recall from that standpoint.
And you've said you're waiting to be confident inflation is heading toward your 2% target before.
Well, like we said on the bingo card, it was all about timing.
Would you be in favor of lowering rates right away?
Unity.
It's not quite the way I would put it. I said that's why we think policy should be restrictive, is because inflation is above target. When we have risks to both goals, one of them is farther away from goal than the other.
Yeah, Max, check out my tweet.
Employment's at goal, so you have to. That means policy should be tight, because tight policy is what brings inflation down. If you came to the view that the risks to the two were more in balance, that would imply that policy shouldn't be restrictive. It should be more neutral, more a neutral stance, and that would be somewhat lower than where we are now. No one knows exactly where that is. So that's the framework I think I'd be taking, and we'll just have to see. We're going to be obviously looking at a lot of data in the next cycle. It is one of the cycles where we have 2 employment and 2 inflation reports, and we'll see where that takes us.
Thank you, Mr. Chairman, for taking the question. Jeff Cox from CNBC.com. A metric that you like to cite a lot is a final...
Wait, how do they have 2 CNBC people? This isn't fair. This is a scam.
2% gain in second quarter from 1.9% in Q1, suggesting that there's some softening in underlying demand. I just wonder if you look at that, you combine that with some of the housing numbers, the weakness that you acknowledged at the top of your remarks, that the housing market is in fact weak, and the inflation numbers from GDP today came down to 2.1% for headline, 2.5% for core. I'm wondering how much more movement you would need to see from these data points before you would be comfortable with cutting in, say, September.
It's going to be the total. Hard to answer that specifically. PDFP, I think, for the first half, private domestic final purchases, or final sales, as people call it, was 1.6 on the first half. GDP, I believe, was 1.2%. That's the whole half. You mentioned the quarters. So those are slower, but GDP is bumpy quarter to quarter, half to half, and often gets revised after the fact. The labor market data we still think is continue to think is the best data we have on the economy, and that shows a 4.1% unemployment rate. It shows wages still at a healthy level, but moving ever closer to what we would regard as long-run sustainable, consistent with longer-run productivity and 2% inflation. So the labor market is actually still quite solid. Inflation is above target, even ignoring tariffs. It's a little bit above target, and tariffs. So we're watching all of that, And again, trying to do the right thing in what is a challenging situation because you're being pulled in two directions, and you have to decide which of those to go in. And actually, at some point, if they're sort of equally at risk, then you really want to be at a neutral policy stance, which we're not right now.
So it'd be safe to say that if the data kind of stays in line with where it is right now, that you wouldn't be comfortable with cutting in September?
I'm not going to say that. No, I just think we're going to need to see the data, and it can go in many different directions. The inflation data and the employment data, and we're going to make it.
I wonder if he knows the Friday employment numbers.
And based on that balance of risks analysis that I mentioned.
Thank you.
Greg, Rob, for the last question.
Last question.
Thanks, Chair Powell.
Then summary.
Greg Robb from MarketWatch. The Treasury Secretary has said recently that it would be confusing for the markets if you stayed on as a governor after your term as chair ends. And I was wondering if you had any update for us on the decision on that front.
Sorry, I do not have any update for you. Thanks very much, everyone.
Let's go. I love that. You see him like close the binder? That was diabolical. He just starts, as the guy's asking his question, just slowly closes the binder. Nope. See ya. Diabolical. Love it. Oh my gosh. All right. Holy smokes. All right, let's get into it. Well, folks, we just had the Federal Reserve presser, and the market had a little bit of a heart attack for a period of time. Unclear what this is going to do longer term, but I will give you the bottom line of what Jay Powell just said, and it's not what we want to hear. We did not get any setup for a September rate cut. Instead, Jay Powell basically told us we should be grateful that he's not raising rates because inflation is already showing up in goods prices. In other words, be happy, rates ain't going up. What? That was not what we were expecting getting into this meeting. The market broadly has been pricing in an over 60% chance that we're going to get a Federal Reserve rate cut of 25 basis points in September, and that would potentially set up either cut, skip, cut, or cut. Well, the odds of that just got poopy-doopied, and they have plummeted by nearly over 10% already. I mean, we're less than a coin toss now chance of getting a rate cut in September. And I think as more economists update their projections and you start getting the bond market trading on this, we will see these September rate cut numbers change very rapidly, especially over the next 2 days as we wait for the next Fed jobs report. But what we also got from Jay Powell, in addition to this comment of, hey, be grateful we're not raising rates right now, is this comment that we're going to wait and see what the data tells us. And then people are like, all right, cool. So like if the job data comes in weak, are you going to cut? And he's like, I don't know. We'll have to wait to see what the data tells us. And people are like, what? This is not what we expected from a quote unquote transparent Fed. Usually when the Fed is getting ready to cut in the next meeting, they tee it up. You know, they put the ball on the tee because they don't know how to play real baseball, so they play T-ball. They put it on the tee, and they're like, all right, let's get ready to swing, and they tee it up. No tee, okay? No bat, no tee, no ball today. Jay Powell took the ball and left. Diabolical, okay? In addition to that, people are like, okay, well then if the data on Friday comes in bad, like, are you going to cut at that point? Don't know. We'll have to wait and see for the data. You know, right now we just want to pay attention to the top line of the unemployment number because we're seeing the supply of labor go down and the demand for labor go down, which is a sign of a weakening economy. The only reason the supply is going down really right now is because of immigration policies, which we'll see how, you know, that affects the economy longer term in terms of consumer spending. But I mean, consider for a moment when you have ICE raids reducing the supply of labor, at some point those ICE raids probably chillax after the sort of the political wave of it all goes by, and then you still have a weakening economy. So then you still have demand weakening, and if supply stabilizes at some point, you're going to see the numbers show up. I think that's what Jay Powell's trying to suggest when he says, oh, well, you're going to have to pay attention to the top line number. But he's never told us before it's the top line number that matters. Usually it's always been the underlying metrics. How many job openings do we have? What are the quits levels? What are the, layoff rates? He didn't mention the word layoff once today, which was mind-blowing to me because in previous Fed pressers, he's always talked about how important layoffs are. And as soon as we see layoffs, we're screwed, basically. He didn't even mention that today. So he was really, really like, this meeting today felt like it was just designed to be a middle finger to Donald Trump. That's what it felt like. Like, we're not cutting. We're not interested in any of your comments. In fact, like, look at this most diabolical moment here from Powell. Somebody asked Powell, hey, like, are you going to leave? You know, basically, like, Donald Trump's trying to get you out. Like, do you have any comments on this or whatever. Before the guy's even finished, like, asking his question, Jay Powell just looks down and closes his binder and walks out, essentially. Look at this. It's diabolical.
Sorry, I do not have any update for you. Thanks very much, everyone.
Basically, do you have any update on Trump asking to leave? It's just like, that was just his mood today, right? So I'm setting you up with a few things here, right? We're setting you up with this mood of close the binder, walk out, take the ball and leave. We're setting you up with this mood of pay attention to the top line employment number. That could be a hint. We've never heard of Jay Powell talk about that before. Are we going to get a really bad unemployment report this Friday? Because he's never just talked about the top line number. And then he's like, be grateful we're not raising rates. So I don't know. I feel like we're kind of expecting something on Friday that maybe says, hey, that the economy's hot, and we should be grateful that rates aren't going up, which theoretically should be good for stonks, but stonks aren't really happy because he's also setting us up for a long wait. Now, I'll explain that in just a moment. I just want to remind you that in 2 days, coupon code Release the Files expires. Remember, you buy once, you get lifetime access, all 8 courses, the trade alerts. We got some coming starting tomorrow, which will be really fun. Then we've got some new trading challenges starting tomorrow. We've got every private live stream, alpha report, every single course, real estate, do-it-yourself property management, you name it. All the courses and the alpha report, one price. Use coupon code Release the Files. And thank you to all of those who have been joining. So what else do we have? So Jay Powell then gets into this idea that inflation may actually take a lot longer to see from inflation to from tariffs. So we might not be able to just say that inflation is going to be a one-time phenomenon due to tariffs. In fact, he once again gives a middle finger to Donald Trump, and he talks about the Donald Trump washing machine tariffs. He says in 2018, under Trump 1, we tariffed washing machines, which then you would expect the prices of washing machines to go up. But that's not actually what happened. A weird phenomenon happened, which could be defined as corporate greed, and it was that the prices of washing machines and dryers went up. In other words, both prices went up. So what you end up with is what Jerome Powell calls this phenomenon of companies will cross the street in a group. In other words, some companies will take advantage of tariffs and the discussion around tariffs to raise prices. So basically, hey, we're having a tariff sale. Get in before the tariffs. Oh, prices are up because of tariffs. It's not our fault. It's because of tariffs. It's just a middle finger to Trump, but it's also a way of saying, hey, yeah, in 2018, that is a phenomenon that happened under Trump tariffs number 1. So he's not wrong to say it, but he's very clearly highlighting Trump's uncertainty that he's creating in this sort of tariff drama around why the Fed is going to go slow. Now, this was probably a pisser for markets as well, because while Jerome Powell said, hey, look, labor conditions are solid, payrolls averaged 150,000 jobs so far this year, conditions in the labor market are broadly balanced, he talked a lot about how tariffs increase unease and they delay when we get the data. We don't know yet how many months of data we need. You know, everybody thought in April, okay, we'll have our tariffs in April, we'll be liberated, and then it'll take 3 months to see the data, and then we'll be able to make a decision. Well, Jay Powell here is basically implying we might not do rate cuts at all this year. Why do it this year? What's the rush? Let's just wait until the data tells us what the full effect of tariffs is. Mind you, we still have no idea where tariffs are going to end up because they're still being negotiated. Literally during the press conference, You've got Donald Trump announcing 50% tariffs on Brazil, exempting the aircraft manufacturer Embraer, while at the same time removing the de minimis exemption, which will affect, obviously, you know, Amazon to some extent, Temu, Shein, and some of these other Chinese places. It sounds like because he's in discussions with China, he's trying to kind of like, ramp up the pressure on China a little bit and get some negotiation leverage on China. That's what it sounds like to me. But anyway, you know, Jay Powell tells us, hey, so far payrolls are averaging 150,000 jobs so far. This is good. I'm looking for hints for this Friday jobs data. The only thing I can get is that he's leaving a big hint here that something about that headline unemployment rate is either going to be really good or really bad. And, you know, that's coming up on Friday. Maybe nothing changes and maybe he didn't know, right? But that seems to be the hint that markets are reacting to. He also talks about averaging out GDP, that you kind of have to average out the first quarter and the second quarter, and if you do that, you see growth is like between 1 and 1.5, or 1 and 1.2%, which is way lower than the 2.5% rate where we were last year for final domestic purchases. And he sees that as a risk that, yeah, look, the economy's slowing, banks are happy, the labor market is happy right now, delinquencies are decently happy right now, they've sort of peaked out, it's not like they're skyrocketing, so things seem fine right now. And that gives the Federal Reserve the luxury of waiting. Now, when he's asked about the two dissents, because obviously we didn't cut rates today, we already knew this, we already anticipated that Bowman and Waller would dissent and that they would want a 25 basis point cut now. We already anticipated that. That's exactly what happened. When Powell was asked about them, he said, hey, you know, they have a different opinion, and that's what you would expect in a time like this because there's so much uncertainty, and we can't really give you a setup on the data because we don't know. This is unique, and we're just basically going to wait. Not great. Then he also poo-pooed the effect of the big, beautiful bill because he said, hey, you know, the reality is a lot of the big, beautiful bill is just extending tax cuts that were already previously in place that are just expiring. And so, yeah, there'll be some stimulus, but not really a big contributor. I take some issue with that because, you know, the capital expense deduction, the 179 getting boosted back to 100% is pretty powerful and I think should be stimulative. But maybe that's the small stimulus he's talking about. But the Fed's downplaying the big, beautiful bill. They're upplaying the impact of tariffs on goods. This, to me, just seems like a war between Donnie. And now the question is, how pissed is Donnie going to get? Because if Donnie listened to this stream, which I doubt he did, he'll just get a TLDR from like Kevin Hassett or whatever. It'll go like, it's time for Powell to go. You know, that could lead to some more volatility in markets. I don't actually think Trump will ultimately fire Powell, but this was a pretty ballsy meeting from Powell. Again, no setup for a rate cut in September. Telling us to pay attention to the top line unemployment rate, something he's never done before. And he's not giving us a setup on the data. He's basically like taking away all of the things he used to give us as guidance. He's taking away, and he's basically saying it's going to take a lot longer for risks and data to really be fully understood, and we have no effing idea. And I think that's why when you look at markets today, markets are like, crap. We've got the 10-year rising. What is this? 4.2 basis points right here. We've got the stock market losing the lead. I mean, this is our uptrend line, lost it immediately here, down 25 basis points now on the Qs. So, we'll see. But obviously, market's not very happy. And so we'll see how this ends up filtering out through the coming days. Most importantly now, the big highlighter on that Friday jobs report. I'll be covering it live, so I'll see you there at 5:30 in the morning. Make sure you're also getting your alpha report every single day, sent to your phone, however you want to get it. If you want Discord, you want phone, whatever, we'll make it happen for you. Make sure you get that alpha report. Sign up at meetkevin.com, and remember, use coupon code RELEASETHEFILES, because if there's one thing we all know, it's that Jerome Powell will cut rates before the Epstein files ever get released. Bye. I'm going to go now. That's all I really have. Good luck on the closing today. Get life insurance. I'm going to suck on the rest of this Pokeball. Get yourself a Pokeball too. And life insurance.